Welcome to our webinar, How to Optimize for Growth in a Low Growth Economy. Today, we're going to discuss trends and the implications that are impacting slow growth and share ideas with you as business leaders that you might consider exploring to position your teams for success. When revenue and profits are at risk, many companies during economic uncertainty desire to grow revenue and reduce the probability of losses. So how can companies accomplish these goals? That's what this webinar is all about. And we've got 30 minutes for the webinar, and we looked forward to allowing for time for Q&A. I'm Jennifer Hogberg, Vice President of Advisory Services and Partner at SEG. I came to SEG from a global sales training and coaching company, and prior to that enjoyed a 30-plus year career at Xerox Corporation in sales.
My name is John Misha. I'm thrilled to be here today. I started my career as a serial entrepreneur. I did a stint in management consulting, had a few Fortune 500 leadership positions, spent a few years in the realm of private equity, and I've spent the last decade or so working with middle market firms to accelerate growth, expand margins, and achieve their business outcomes.
And I am Crystal J. I'm going to be the person behind the scenes. I'm going to turn my camera off while Jennifer and John present, just so I don't take the focus away from them. But if you have any questions, please go ahead and post them in the question panel. You can go ahead and click on questions and send a new question. Thank you so much for joining. I'll turn it back to Jennifer and John.
Thanks, Crystal. So I don't think it's controversial to say that it's really hard to grow these days. In fact, one could argue it's never been harder to grow. Everywhere we turn, we see reports of record unemployment. I feel like every other day we're hearing about the recession is coming next week, next month, next quarter. There's anecdotal comments that people just don't want to return to work. And whether you believe that to be true or not, there is objectively information, data out there that shows that worker productivity, forget quiet quitting, worker productivity is at an all-time low. And in fact, in the last few quarters, it's turned negative. So this is really leading to a level of stagnation that is very difficult for us to achieve growth in the current marketplace. And I want to pause right there and go to the next slide and invite everybody who's listening today to join us in our poll. So in the right-hand corner of the screen, you're going to see a little symbol that has a graph line on it, and that's our poll. And I'd like everyone to just share their views on what they think the next 12 months of economic forecast will look like for the U.S. economy. We'll just give that a minute or two for people, or a few seconds for people to chime in. And it's looking like there's a consensus view that people are pessimistic, whether they are somewhat or more. There's a few people who look like they're neutral, and God bless you, there's somebody there who's very optimistic. So I'd love to be in your shoes. Continuing on into the next slide, what we have here is an historical and economic forecast growth from the Congressional Budget Office. This is a nonpartisan office. The Congress looks to the CBO for unbiased data on a variety of economic indicators. What's remarkable here is if we look at the golden age of the US economy, the 1950s to the 1970s, this is largely credited for the era that really gave rise to the middle class, the prosperity of the middle class in the United States. We saw real GDP growth. So this has been adjusted for inflation. We saw real GDP growth at about 4%. And even from the 70s to the 80s, we saw relatively strong GDP growth of 3%. What's also remarkable here is that the contribution of the labor force, so the number and the quality of people in the labor force, as well as the productivity of those people in the labor force, was fairly evenly distributed, not quite 50-50, at least in the 1950 to 1970 period, but it doesn't feel as though it was lopsided. When we look at more recent years and we look at the forecast into the future, the two things that are very remarkable is that we see real economic growth forecasts and actual data coming in at less than half of our historical high. We also see that the number of individuals, because we do have a shrinking US labor force in the United States, by some estimates, there are 6 million too few skilled laborers in the United States today. The contribution of the number of individuals is much, much lower, right? 40% versus 100, or 0.4 versus 1.4 in the out years. And the majority of growth is coming from labor productivity. Now, that wouldn't necessarily be a bad thing, except when we look at the next slide, what we see is that US labor productivity is not just at an all-time low, it's actually turned negative over the last 12 months. So what we're seeing here is US labor productivity from the Bureau of Labor Statistics, again, another nonpartisan statistical reporting entity from the US government. We all see here that during COVID, there was a massive spike in productivity. I think when we all have a gun to our head, we can all agree that there's a level of focus there that happens. We all lived through that. We remember that. But going into the last 12 months, whether this is quiet quitting, whether this is a hybrid versus remote versus in-office contributor, that's all speculation. But the data speaks for itself. US laborers are not just at an all-time low of labor productivity is turning negative, right? And so in this sort of environment, it just sort of begs the question, what can we do to invest in our people and to offset that trend, right? The other contributing factor here is the rise of AI and whether that's going to lead to new opportunities, cannibalization of existing roles, more productivity within the existing roles that we have. So on the next slide, I'd like to invite everyone again to chime in as to their thoughts about artificial intelligence and what its contributing effect may be in the workforce. So if we can go back over to the poll, and again, what we really want to know is, are you considering AI? How do you think it's going to impact your staffing? And again, we'll just give this a moment. All right, you know what? Is everyone able to click onto this poll? Jennifer, are you able to click onto this? Oh, okay.
I think it just posted, a little bit of lag.
Yeah, there we go. Just want to make sure everyone has a chance to chime in. And again, we'll give it another 10 or 15 seconds for all the results to tally. And wow, this is an overwhelming consensus that
Really interesting. Yeah.
it will lead to augmentation and support. So yeah, very, very, very high level of consensus there. Nearly 90% of attendees think it'll lead to augmentation and support. So the fact is, what we're seeing here is objective data that does demonstrate we are in challenging times. The data doesn't seem to be trending in any direction that would seem to give us a clear path as to what the proven approach to achieving success might be. So I'm going to hand the reins back over to Jennifer for the next slide to talk about what this might mean for those of you who are tuning in today.
Yeah. So, where does this leave you? We've been talking about some of the trends. Certainly, Jonty just mentioned AI. We can see that, there's been an increase in growth of rate of AI, especially, reaching out to 2030. And, some industry experts are saying, Forbes particularly, 400 million workers could be displaced because of AI. So if we go to the next slide, where does this leave us as business owners? Business owners, founders, PE firms, it certainly leaves us feeling a lot of uncertainty because the economy is volatile. And that's one of the trends that we just talked about. Jonty also talked about unemployment being low, risk of recession, and employees, really are reluctant to come into the office. And all that's driving toward productivity, low productivity. And then when we layer in AI, leaders are really looking for guidance and support. So what we've learned over the years in 1,000 client engagements is that when we're in an economic slowdown, it's a good time to prioritize areas to retool the team. So some possibilities that you might think to explore further. You might consider identifying an optimal structure design for an effective go-to-market strategy for your company. You might think about determining key roles or right-sizing your team that might be necessary for optimal customer coverage. Next, you might consider investing in strengthening the sales team, perhaps recruiting additional sales talent. So during a reset, it's an opportunity to review, optimize, maybe look at compensation programs and incentives to motivate and retain your top talent. And even more important, to work with chief revenue officers, your chief sales officer, and the customer success team to double down and look at customer experience and retention. Net retention is a key performance indicator for your success of your investments. So in the next slide, it doesn't really need to be this way. There are proven possibilities out there that can assist in building higher ROI, lowering churn of employees and colleagues. And you can deploy proven ways to improve sales velocity. Over the last 10 years, SEG's worked with PE firms, S&B, startups, Fortune 500, and has driven over 1.2 billion in revenue growth. And we've done this by applying proven methods, best practices that are really focused on accelerating growth and profitability. So over to you, Jonty.
Sure. So on the next slide, we heard that $1.2 billion of incremental revenue growth. And that's an impressive number. It's almost too large to fathom. So let's break that down and try to understand and contextualize what that could mean for a mid-sized organization. What we see here is data from a research study from McKinsey & Company. I believe this include about 1,000 firms across a variety of different industries, largely in the middle market space. And what McKinsey looked at was looking at the revenue producers of an organization, the sales producers of an organization, and exploring the bottom quartile of producers and indexing them to a 1 and just saying, this is our baseline. What is the incremental productivity of a revenue producer, a sales professional who's in the median quartile? And the answer is that the return on investment of a sales producer, a revenue producer in the median quartile is approximately 60% higher than it is for somebody in the lower quartile. And then they extended that analysis and said, well, what does that look like when we look at the top quartile? And again, these are people at 75% and above. So these are not the rock stars. There are some rock stars in that quartile, but we're talking 75% and above. That's a C plus, right? And when they looked at the average, the people in that 50th percentile, and they looked at the top quartile, they saw another approximately 60% improvement. And so what that means is that if your below average producer is producing $100,000 of incremental revenue per year, $1 million of incremental revenue per year, whatever that may happen to be, your average folks are producing 60% more. And then your above average folks are producing 60% more again relative to your average folks. So this belies the question, what can we do to take our below average folks and just get them to average? And what can we do to take our average folks and get them to above average. And whether you think that a 60% improvement is high, medium, or low, the fact is it is possible. And in order to understand how that's possible, I'd like to pull in on the next slide the example of Michael Phelps. If you don't know who he is one of the all-time winningest Olympic athletes. He's a professional swimmer, and he personally holds 28 medals, of which 23 are gold medals. And he holds more gold medals than 174 countries. So he's a member of our country. He's got other people on the team, and he blows away the entire team of 174 other countries in all categories, not just in swimming. Just for reference, there's only about 190, 195 recognized nation states on the planet that can go to the Olympics. So this is clearly an outperformer, right? This is clearly somebody who is in the top quartile, to say the least. He's a one percenter. So how does he do this? If you look at any interviews with him, and frankly, if you look at any commentary of any high-performing sports athlete, what you'll see is that he treats every aspect of what he does as part of a process, not an event. And we hear this all the time in sales. Sales is a process, not an event. For a long time, when I was working with startups or when I was working in the private equity community, I would often hear investors say, we want to optimize processes, not optimize for outcomes. And the reason is you might get lucky with an outcome, but if you optimize a process, you can really then hone in on what are the secret ingredients that it takes to get to the outcome that you're actually looking for. And so the example here, whether you follow Michael Phelps or you are a football fanatic or you like to watch soccer or baseball or hockey or basketball or any other professional sport, we can all imagine, we've all seen, we've all heard, we can all close our eyes and see very clearly this concept of an athlete on the field who's a member of a connected team. There's a shared vision. There is a panel of advisors around them, whether it's the coach, the nutritionist, the physical therapist. Every action is discussed, is studied, is executed, is video recorded. And then after the hard work on the field or in the swimming pool takes place, they go back into a locker room and they watch what they did and they discuss what was effective, what led to the outcome that they were looking for, and where is there room for improvement, right? I wish that we saw more of this in the realm of business. I wish that we saw more of this in the realm specifically of revenue production, of sales management. Unfortunately, all too often, we bring in, a hot shot, cool-headed person. We say, go out there, go hunt, go kill, go bring it in. And then maybe once a week or once a month, we look at a few numbers and we either compliment somebody or we ask them what they could be doing better. This approach of thinking about every aspect of the value chain of activities that is the process that is necessary to deliver the outcome is something that is done fairly often in the realm of professional sports, but sadly not often enough in the realm of business, and certainly even less so in the realm of revenue production. So if we go to the next slide, this lets us get back to the contextualization of that $1.2 billion number that SEG has helped clients to achieve. How might your organization undertake some sort of revenue advancement for yourselves? So let's say you are a middle market organization, and you've got 10 sales professionals, 10 revenue producers within your organization. Well, if you can adopt that cultural mindset of looking at process optimization, investing in your people, providing that mentorship, that training, that open access to discuss what's not working, as opposed to just beating up people when things aren't working. And I'm not suggesting anyone here does that, but we all know that that's more common than not. What is the economic value of that? Well, if we go back to the McKinsey data that we saw before, and we talk about the outcomes that Jennifer described, and let's just focus on higher ROI of sales. if you could take all of your below average people and just get them to be average, that's not a huge task, right? And they were only producing $100,000 of incremental revenue sales per year, that would be a $60,000 per person improvement. And if we could then take your average people and just get them not even up to the 75th percentile, right, which would be another 60%, which is actually a lot more than $60,000, just get them halfway there, just another $60,000. That's $120,000 in improvement in ROI of your revenue producers. And if you have 10 of them, that's well in excess of $1 million a year. And that says nothing about the soft dollar savings and hard dollar savings of reducing churn, right? Soft dollar in terms of productivity, a hard dollar in terms of recruiting costs or severance costs or just lost sales opportunities. And it says nothing again about the acceleration of your sales funnel, right? And again, if you can take your below average folks and get them to average, and get your average folks and get them to above average, in addition to the absolute dollar figures that are here, the practical implication is that we're taking a 90 or 120 day sales cycle and we're compressing it down to 60 or 90 days. And so when you just run that math, that's another 20 to 30% incremental revenue impact in a 12-month calendar view, because you're taking 15 months of revenue and compressing it down to 12, right? So this $1 million impact for a mid-sized company with 10 sales producers is actually very conservative, because we're not factoring in all the value propositions that are here. So with that, I'm going to give it back over to Jennifer to talk about where and how we've actually been able to do this for clients.
Thanks, John T. So I want to share with all of you some ideas to think about as you might look to make an impact on these three imperatives. For each one of them, I'm going to offer up a couple ideas for you of what you can do to put some things into place coming out of today's conversation. So many of these outcomes that I'm going to talk about are based on real SEG case studies. So the first one, higher ROI on sales. So a couple strategies just to consider. Prioritizing customer success and retention efforts. I mentioned that earlier. Studies have shown that when acquiring new clients, it can cost up to 5 times more than retaining existing ones. So emphasizing that customer experience, make customer calls a priority, approach renewals as a 365-day sales cycle. So not just calling on them a few weeks before the renewal date. This focus could help drive upselling and cross-selling opportunities. And the result is certainly building your pipeline. And lastly, you could consider building an effective demand generation team. And this is hard. It takes time, sometimes more time than it should. But in a downturn, this represents particularly good opportunity to invest time in this. So you can see listed there some of the impacts that SEG has made just by leveraging a few of those ideas. Secondly, lower churn of colleagues. So a few strategies to consider here. Sales managers, coach the reps during regular one-on-one meetings. Teach them how to inspect opportunities correctly, and perhaps focus on the high probability deals. And if bandwidth is an issue, hire a deal coach. Sales managers should also be working with the reps to create individual development and coaching plans. And this enables employees to feel valued and motivated. And again, you can see some of the impacts to these approaches listed below. And then lastly, with improving sales velocity, I have 3 ideas for you here. So during an economic downturn, we've got limited luxury to slow down, to speed up. So assess and retool your sales strategies and prioritize opportunities that drive growth more effectively, and tailor these to each of your target industries or prospective companies. Ensure that your company's pipeline creation does include lead gen and outbound prospecting, and ensure that those strategies are effective and, more importantly, correctly measured. An idea here might be measure on percent of pipeline contribution. And lastly, implement or improve automation to better align sales and marketing. Even at the tactical level, you could assess how to improve that campaign management or even look at lead scoring to increase conversions. So listed here are many of the impacts that SCG has made on some of these approaches. Over to you, Jonty.
Thanks. So here's where we're going to wrap it up. On the next slide, if you're looking to go for the gold, we hope that we've given you some thoughtful considerations on things that you can implement today in a daily practice of your business operations. But we'd like to point out that if you are reluctant to figure it out on your own, we are here to help, right? And we get calls all the time from clients that are dealing with explosions in growth, right? And they're the staffing and a training consideration that we can provide. We get fewer of those calls these days than we have in the past. But the reality is, anybody who's experiencing a trend in the direction that they don't like, or spikes within that trend as it pertains to growth, as it pertains to your costs, your profitability, seeing your sales. I think sort of a leading indicator here is when we hear people say, it's just timing, it's just timing. And then a 30 or a 60-day close tends to roll into a 90 or 120-day close. And the organization starts to get a little leery about taking things off the pipeline. If you're seeing spikes in any of your key performance indicators, or you're seeing them trend in the wrong direction, or you're not sure what key performance indicators you should be looking at, certainly anything that we've covered here today and anything here that you would like to talk about, we would be more than happy to discuss with you. And Jennifer, I'll hand it back to you for the final thought.
Sure. So we want to thank you for attending today's webinar, and certainly, we are here to work with you and certainly be a resource for you. So we look forward to continued conversations coming out of today's meeting. We do have a few minutes, so I'm going to turn it over to Crystal and see if we've got some questions that we would be able to address for any of you. Crystal?
Of course. Yeah. So thank you so much. We do have a question. Can you share, we have a couple of questions. So the first one is, can you share a couple of examples on how SCG delivers on the bend the curve and what concrete tools and processes are deployed?
Yeah, great question. So I'll just share a story with you. Myself and our chief marketing officer worked with a client for about a year for both sales and marketing alignment. Just so happened that this company was owned by a PE firm. There was a lot of pressures from the PE firm. They wanted results after a year of stagnant growth. I will tell you, the client executives had concerns. Did they have the right people in the right roles, et cetera? So we used some industry tools to baseline the organization and the skill sets, and worked with the sales managers to create a plan to upskill and provide training and coaching for the entire sales organization. And so after 90 days, we did that and kept testing it every quarter. And at the first of the year, we helped management make some decisions in terms of individuals. But I will say by the end of the year, pipeline growth and revenue acceleration was a result. And ironically, 90 days later, the PE firm did sell the company for 3 times what they paid for it. So there was a big impact to putting in place the right processes and tools and supporting the organization moving forward. So case study we're definitely very proud of.
I'd like to add to that too. I should have mentioned this in advance, but I'm a former SCG client. And so that's probably worth noting. I like the product so much that I'm now part of it, I guess. I had a challenge that SEG really helped me through, and it really dealt with the curve in productivity. The parlance that I think through, which is analogous to SEG's framework, although they used slightly different terminology, is there's suspects, prospects, leads, and then clients or customers. And suspects are, we don't know if they want to work with us, and they don't know, we don't, they don't know who we are, we don't know who they are. And prospects are, that's your ideal customer profile. And they've put their hand up and said, I'm interested in having a conversation with you. I found that a lot of my sales professionals were prospecting against suspects, right? And so that's a very, very time consuming, low ROI activity. And so simply honing in on ideal customer personas, unmet needs, and unique value propositions, it really was transformative in cutting away, I hate to say it, garbage time wasted during the day, firing communications, whether it was telephonic, email, or through LinkedIn, to people who were just not a good fit and not in market for what our value propositions were. And by cutting away that garbage time and sharpening up the message and really prospecting against prospects and then nurturing leads, we saw our velocity and we saw our ROI just have a step change function. So that's a real world, another case example from a former client. So for what it's worth.
No, great examples. The next question we have is, you mentioned the growth of AI, so creating uncertainty about the future. How can businesses better adapt and take advantage of AI investments instead of really feeling threatened by them?
That's a really solid question. The way I think about it, the other day I was talking to a colleague who said that their organization had IP blocked ChatGPT because there were some concerns over a variety of issues. I don't want to criticize that approach, or I don't want to criticize that action because there could be some legitimate concerns there. But I think history has not been kind to people who turn their backs on technological innovation, right? AI is very new, but a transformative or disruptive technology is not new. It started with metal, and then whether it's the telegraph, the telephone, or the television, we've all seen, or the internet, or the fax machine, we've all seen transformative technologies. I think the key here is to have an open mind to it and to really allow, within reason, your colleagues within the organization to have a voice and experiment and play with these emerging technologies, as long as there's no legitimate IP concerns. I don't think anyone's figured it out. And again, I think history has shown very few people came up day one and said, I know what the future looks like and I'm going to go build it. What typically happens is people are open and receptive to embracing those technologies and playing with them. And I think from a poll that we saw earlier today with this audience, because there is a view that AI will be augmentative to productivity, I like to think that today's audience would subscribe to that view.
Great. All right. And then we're going to wrap up with a question on ROI. So can you share a success story where a company not only experienced a higher ROI in sales after working with you, but also saw significant improvements in employee retention?
Yeah. So, Crystal, where my mind goes on that is really back to the example that I just shared with you. And building on that same story with this client is there's been other clients that we've worked with where it's very important to baseline the organization and then put in place the right measurements. And oftentimes we sit down with the owners and leaders and executives of those companies to really understand some of the challenges inside the organization so that we can work through prioritizing the right tools, processes, technology to help really make an impact on those business challenges. So it's definitely a consultative conversation where we roll up our sleeves, we execute on those ideas together. We're not just, a consulting company that comes in and makes, recommendations. We get in the trenches, and we've got the right team to help our clients really move forward and make an impact.
Yeah, great working together. So awesome. I think those are all the questions that we had. Those are all the questions that we had for today.
Wonderful.
Again, thanks for joining, everyone. I know that Crystal will be following up with a recording of today's event. And again, we look forward to being a resource for you in the future. Thanks for joining.
Thanks, everyone.
Thank you.